As another trading week comes to a close, Nick Stamenkovic joins me down the line to dissect what really went on and how the markets reacted to it. Nick, welcome. So if we start things off with this morning's news from Japan, the BOJ held still on stimulus as Kuroda bets on a rebound. But amid far from convincing data, where is this positivity coming from?
Well, I mean, certainly, judging from the latest data, Q2 GDP looks like it's fallen, though we don't have official data yet, primarily because of weaker net exports, but also consumer spending. But some of the forward-looking surveys, particularly the Bank of Japan Tankan survey, did show a healthy rise in confidence, both manufacturing and non-manufacturing. And we also saw a significant upward revision to capital investment. So the Bank of Japan still seems relatively sanguine about the economic outlook, and hence they don't seem to be in a rush to provide any further stimulus to the economy at this juncture.
And next to US NFPs, the jobs rate rose to 115,000, which is a bit of a disappointment and raising suggestions there are reasons why the Fed shouldn't move, but they will because of the financial conditions. What do you make of that assessment, and where does the dollar go from here?
Well, I think the payrolls data really doesn't change the underlying picture too much. The labour market continues to tighten, in my opinion. Job growth is solid. The missing ingredient is higher wage growth, but the Fed has made it quite clear, particularly Yellen, that higher wages are not, wage growth is not a precondition for higher rates. The divergence we're seeing, between the US and particularly emerging markets persists with all the problems in China. Hence, I think the dollar will continue to make headway against the emerging market currencies, particularly as commodity prices fall. And the euro is vulnerable as well, but as yet the ECB doesn't show any inclination to extend QE. But if inflation data disappoints in coming months, then the ECB could extend its public sector purchasing programme.
As you said, there seems to be just no wage inflation in the US. In Brazil, the economy has massive inflation but no growth, and the real seems oddly attached to the price of crude. Nick, help us out. What is going on here?
Well, Brazil's in a real pickle. On the one hand, inflation is very high, and policy's been tightened very significantly, though the central bank signaled the long recent monetary tightening cycle has come to end. The economy itself is deep in recession and unemployment is rising. It's a very bad mix for investors at this juncture. On top of that, the S&P warned or put Brazil on a negative rating a couple of weeks ago, increasing concerns that Brazil could lose its investment grade next year and lead to forced selling of bonds. And with Brazil, a commodity country and very dependent upon commodity imports, particularly from China, the currency has taken a significant hit. So I think, until we see a significant improvement on the fiscal front and an improvement on the inflation front, I think the Brazilian real is vulnerable to further weakness.
Now, when the Athens Stock Exchange opened on Monday, investors started selling. Next week, we have GDP from Greece and the Eurozone, with analysts expecting moderate growth at best. What is your outlook, and what else should we keep an eye out for?
Well, I think in terms of the euro area, the recent PMI surveys, the composite PMI survey we saw over the last week, is consistent with further modest growth in the second quarter, and I think that's what we'll get. And I think we'll see not just modest growth in Germany and some of the other core countries, but I think the peripheral countries, particularly Spain, is where we've seen is doing much better than many countries within the euro area. But overall, I think the recovery is modest and it's become a bit more broad-based. But the unemployment rate is still high, inflation is still very low, so the ECB will maintain a very accommodating stance. Greece is clearly the outlier. It's the deep recession, credit controls are just worsening that situation, and the unemployment rate is extremely high. So the Greek economy is a very precarious position. And we have the labour market figures in the UK. They'll be keenly watched. If we see any signs of wage pressures building, not just in the headline figure but excluding bonuses, then investors will start to increase the odds that the Bank of England could move rates early next year, in the first quarter rather than second quarter as per now. But the message from Mr. Carney is clearly that the Bank of England is preparing the ground for a rate hike, but is in no rush to raise interest rates. And even when it does, it will be a very gradual tightening cycle. But I still expect this pound to do well over the medium term and to push hard against the euro in particular.
Nick, great to speak with you. Thank you. Well, that's all from myself for this week. Thanks for watching and see you again on Monday. Goodbye.